it's clear that the secular bond bull market is over. They've moved out of bonds and into stocks, but also a little bit of that capital has gone into gold. And so I think all these factors helped gold just remain in a real bullish position to be able to break out.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vierra, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Jordan Roy-Byrne, editor and publisher of thedailygold.com and the Daily Gold Premium, joins us today. Jordan is a chartered market technician and a master of technical analysis. Jordan's work emphasizes market timing and stock selection for precious metals investors. And we're delighted to have Jordan join us once again today. It's time to saddle up and silver up for Jordan Roy-Byrne. Jordan, welcome back to SBTV. How are you doing?
Hey, Patrick, I'm well. Thanks for having me. How are you?
I'm okay. Glad to have you back on. It's been quite a while since we've had you, so thank you for coming back. And interesting because when we spoke a while back, we spoke on how gold was in that cup and handle formation, or in the handle formation of that cup and handle pattern. And you mentioned how that handle pattern could take 3 years or so before it really makes a move or breaks out. And you were right, my friend. You were right. Great call. Where do you see gold now going? That is, being that it's in new territory now.
I see it going higher and then a lot higher. So gold is in excellent technical position. Whenever you break out to a new all-time high, that is a real technical sweet spot for any market that achieves that, especially after an extended period of time. And if we think about where gold is coming off basically a 13-year cup and handle pattern. Now, the cup and handle pattern began with the 2011 peak around 1900 or 1920, if you want to measure intraday. And the handle started in the summer of 2020. And this handle, even though it basically transpired or developed around, I mean, the peaks of the handle, the resistance developed at a higher level than the beginning of the cup. I mean, even though that was the case, you still were in this 13-year structure where gold was really struggling to break away from the entire pattern, or at least the beginning, that 1900, that 1920 price level. And I may have, if I recall correctly, I may have mentioned it in an interview that we did, that this was a more bullish than normal cup and handle pattern because the handle was building at a unusually high level. Now, a bullish cup and handle pattern is when you have the rim, they're basically at the same level. Like, that's a bullish pattern. But the handle was being built at a slightly higher level. So that indicated more strength in the pattern. And it was nice to see that the handle lasted 3.5 years. So, I mean, that's a really significant amount of time for a consolidation. Even if something consolidates for a year, 2 years, and it breaks out, great, that's bullish. But 3.5 years for a handle, I mean, that's a pretty long amount of time. And, the cup itself was 9+ years. So we're close to this 13-year cup and handle pattern. And just breaking out from that type of pattern is so significant because whenever markets break out from that long of a pattern, these decade-long patterns or things that even last longer than a decade, that leads to serious upside, not just over the next couple years, but over the next 5, 7, 10 years. And so when I've studied markets that have broken out from similar patterns, I mean, they're not perfect cup and handle patterns, but they're similar. The markets tend to move dramatically higher than even the targets. And so this cup and handle pattern, it has two targets. It has the log target, or not, excuse me, the measured upside target, which you're just taking the depth of the cup there and you apply it, you add it forward. And so that gives you, depending on how you measure it, you're looking at 2,800, 2,850, 3,000, something like that. But when you take what I call the log target, which is basically you're taking the depth in percentage terms. So if the depth is 100%, which it was, close to or a little bit more than in this case, and then you apply that forward, you get, again, depending on how you measure it, you can get a target of anywhere from like 3750 to 4100 or nearly 4100 gold. So I mentioned these targets because going back to the history that I just mentioned, markets that break out from these long patterns, they go above, cup and handle patterns rather, they tend to move above both of these targets, and not just in, I'm not going to say really soon, like in a year or two, but it's not going to take 8 or 10 years for this to happen. So not only is gold set up to go to 3,000 and eventually the 4,000, this log target, but I see the potential, over the next 2 or 3 years that, we could see $5,000 or $6,000 an ounce. So the setup is really there for gold to explode over the next, 1, 2, 3 years.
Okay, well, that's definitely good news. But yeah, I remember that time where we saw the right hand of the cup was actually a bit higher than the left hand, and when we were looking at that handle. So it's good news all the way around. But as we all know, nothing ever goes up in a straight line, and gold is going through some chop right now, a little bit of a correction, a little bit of a pullback. But where do you see new support levels for gold setting up?
I think we have there's some open gaps in gold. I think 2240 is one, 2280. I would be surprised if gold were to not fill those gaps and continue higher. Also, if we're looking at the 50-day moving average, I think it's really close to 2200 and it's rising steeply. And so if gold is going to come down into the low to mid 2200s and fill those gaps, it could test the 50-day moving average there. And that's important because I've studied the cyclical bull markets in gold, and I think there's like 6 or 7, going back to 1970. And when in these cyclical bull markets, when gold makes a significant breakout, and gold is really running like it has been for the last couple of months, it tends to come back and correct to the 50-day moving average. Now, at other points in these moves, gold can come back to the 200-day or 100-day or 150-day. But when gold is really moving and it has a lot of momentum and it's running, there's numerous times in history where it's come back to the 50-day moving average, and that has provided support. So I'm not, it's again, it's kind of an art. It's not an exact science trying to project these things, but historically, it tests the 50-day moving average quite a bit. And so I would say, 2200 or, maybe 2240 where you have a gap there. And that could potentially coincide with silver, which silver, when it finally broke 26, there's an open gap there from, I think, 26 to 26.25. So if gold were to come down to those targets, you would probably see silver come down to at least 26.25. The worst case would be silver comes down below that and fills that gap down to, I think it's like 25.92. But, even with that being said, if you look at the stocks, if you look at the miners, they're like in the last couple of days, they're holding up really well. They're even outperforming gold at this point. So it's, it's possible that gold and silver could keep running, but I think, I lean towards over the next couple weeks that we could see metals prices come down a little bit more, and then maybe they could consolidate. So I think this is going to be, from this point, more of a correction in terms of time than price. We've already seen the price declines, which occurred pretty quickly. Now it could be a function of more time, a little bit more backing and filling, where you kind of see just a lot of range bound action in the metals before they, who knows, in the next couple months start to move higher again.
If you're enjoying this interview with Jordan Roy-Byrne and I, please consider subscribing to our YouTube channel. And did you know that at Silver Bullion, there are 6 different types of accounts to fit your needs? Find out more, go to www.silverbullion.com.sg, click on the signups tab, and choose from these 6 different types of accounts. Or email me, Patrick at silverbullion.com.sg, and I'll help to get you started. Yeah, thanks for that. And I am going to ask you some silver questions a bit later. But I think many of us here we thought we'd see, say, like the equities markets, sort of take a negative turn, or somewhere, or see something significant in the markets where we would have seen a sort of a noticeable outflow and then a run into gold for safety. But why do you think we didn't see this outflow where maybe the markets went down and then we saw people seek shelter in gold?
Yeah, it's a really, really good question, and I'm really surprised. This is one thing I've been wrong about in the last few years because I've said numerous times we need to see equity market weakness for for gold to make this breakout and then really sustain it. And so that's something that hasn't happened because this breakout obviously occurred around the same time when the stock market, I mean, it's still basically around all-time highs. So that's a really good question. I think there's a couple things. Obviously, the central bank buying has been so huge. I'm not an expert on de-dollarization, but certainly in the last couple of years, I think that has picked up. So that wasn't a factor in past bull markets in gold. In addition to that, the central bank buying has been so huge in recent years, even, really at record levels in the last couple of years. And so that really helped, I think, that helped gold to remain elevated. And without the central bank buying or without huge buying, you might have seen gold come down to the 1500s. Maybe it would have stabilized at 16 or 1700, something like that. But because of the central bank buying, gold was able to, during the handle consolidation, it was able to rebound quickly back up to the highs. So I think those are important factors, but also bonds, because if you think about, you have the stock market and then you have the bond market, and based on, I've looked at some data and I had someone construct for me a total return on treasury bonds, long-term treasury bonds, going back 100 years or something. And if you divide that by the CPI, you can clearly see, okay, in 1965 is when the bond market really broke. And then also, I think 2021 or 2020, whenever, rates just started exploding higher, like you divide that total return by the CPI, it's clear that the secular bond bull market is over. And so, there's a lot of people who they've moved out of bonds and into stocks, but also a little bit of that capital has gone into gold. And so I think all these factors helped gold just remain in a real bullish position to be able to break out. And, I mentioned, 1964, 1965, because that's the best comp for historically for where we are, because in 1960, the end of 1964, you had the gold stocks breaking out of this 28-year base. And you go back to the 60s and you basically couldn't buy gold. We were on the gold standard. Silver was, there wasn't really a market for that. You couldn't buy tips, you couldn't buy emerging markets. So gold stocks are really the proxy for gold back then. And so the mid 60s, you had this big breakout in gold stocks, but the stock market kept moving for a couple more years before it began its secular bear, although it wasn't really moving that aggressively to the upside. So, so there's a lot of similarities to where we are here and now. And so, yeah, there's not, to think about your question, there's not a perfect answer. It's just kind of a combination of all these factors. But it is an important question because if we see the stock market, roll over and the economy go into a recession in the next year or so, that's going to turbocharge gold and precious metals. And, when I mentioned the targets at the beginning, that's based on, or for that to happen, I should say, you're going to need to see a downturn in a recession. Like we're not going to see 5,000 or 6,000 gold in the next couple of years without a downturn in a recession.
I think one of the other things that could be driving the gold price, of course, is maybe inflation. And we're seeing Jerome Powell starting to walk back his notion of rate cuts. What are we waiting for when it comes to rate cuts?
Well, we're waiting for probably unemployment to start picking up. I think that's real. I mean, there's many things that the Fed and Powell are looking at, but unemployment, once you see the unemployment rate start to go up, I think at that point they're going to be forced to cut. And hopefully for them, you see the unemployment rate rise, and at the same time, um, you'll start to see inflationary pressures subside. But who knows? Because if you're looking, I mean, I don't always track economic statistics, but gold's made this huge breakout, silver's perked up, copper's running again, oil's rebounded in recent months. So the action in the markets is telling you that inflation is going to pick up. And if you look at, yes, short-term inflation indicators have come down, even as the Fed, as they were hiking rates in recent years. But the long-term indicators of inflation did not at all come down when the Fed did all this tightening. So they're in a tricky spot here where, it looks like they're going to have to accept some stagflation here over the next year or two, especially as, again, as it looks like unemployment is probably going to start rising at some point in the next couple quarters. And, you could have more recession risk the end of this year or early next year, potentially. And, I don't know if inflation is going to be declining at the same time. So that really spells stagflation. But that was a really long answer to your question. But it's basically when you have the unemployment rate rising, that's when that's when they'll probably have to ease in the face of inflation expectations really picking up. And I mean, this makes sense. And this is something I was thinking about and saying, several years ago, in that for this cup and handle to break out, or whenever it breaks out, whenever gold finally breaks above 2,100, it's probably going to be when the Fed is forced to ease policy, but inflation is a problem. So now the gold already broke out. I mean, gold has already broken out and already moved a lot before the Fed has to do that. But I think they will have to do that at some point in the next, 9 or 12 months, probably.
Yeah, regarding the Fed and the 5% effective Fed funds rate, typically this is seen as a runway where they can lower the effective Fed funds rate should there be a recession, make money easy again for people to get, stimulate the economy. In other words, the Fed will reduce rates during a recession in order to get that economy stimulated. But is Powell could he be hanging on to this runway, waiting for a noticeable recession to take place where he then has enough of that runway to lower again?
Yeah, it's definitely possible. Well, and their hope is that inflation is going to come down, because if inflation comes down and inflation expectations, yes, that will make it really easier for them to cut. And you're absolutely right about the interest payments. Like, I think that's another thing. Just the U.S. fiscal situation and the budget, the interest payments are going vertical. So that's a huge problem. And that's, at some point in the next year or two, we're probably going to see yield curve control, where basically going to have to print money, to buy bonds and keep rates down, like they did from 1942 to 1951. But back then, you weren't in a new secular bear in bonds like you are now. I mean, that was a deflation. I mean, yes, there was rising inflation in the 30s and the 40s, but there were still strong deflationary forces around. But now it's like it's a completely different situation, because bonds, you're doing this in a bond secular bear market. It's different than if you were doing this 10 or 15 years ago when you were still in a bond secular bull market. But to get back to your question directly, the other thing to think about is, yes, we're in a new bond secular bear, so we're in a new regime, but this is a lot different than the last 15 or 20 years, because there's so much fiscal spending that's driving things, and that's keeping statistical inflation elevated. So, like, when you have statistical inflation at 4%, they if inflation would come down to 2.5% or at least below 3%, they could at least cut. But the problem now is I think the last reading was I think it was around 4%, but we know that it's ticking up, and we know that the commodity prices are telling you inflation is going to be coming. And so therefore, even though the Fed has all this runway at 5.25% or whatever they're at, just you can't they can't dump rates all the way down to 2 or 3% given where inflation is. I mean, you would just see commodities really skyrocket. But that being said, I think gold and silver are going to skyrocket. I mean, there's a risk they're going to skyrocket anyway in the next couple of years.
Let me get to silver a bit because it's often been said silver moves when it sees confirmation from gold. And silver did have a nice run and it kind of pulled back a little, as did gold. Do you think this little bit of a pullback has, let's say, spooked the silver investor where, he may feel with gold pulling back, silver might start to fall out of favor?
I don't see that. I don't worry about that at all. I mean, silver, the $26 resistance level for silver has been very, very important. And so silver got up to, and actually, if you look at the weekly close in silver, I think the last 2 weeks, silver made an 11-year weekly closing high. Now it still hasn't officially broken past that, 29.5, $30 area, but silver's acting fine. Even if it comes back and does a quick retest at 26 or 26.5, that doesn't bother me at all. Silver's in a really good position. And I think it, along with gold, it will continue higher. I mean, there's a measured upside target for silver around 34. If you look historically, if you look at quarterly charts and monthly charts, there's a lot of resistance there at 32, 33, 34. So, that 34-ish for silver, that could be a level where maybe it takes a rest for at least a couple months. But I just the recent action, I don't read much into it. I mean, it's bullish for gold and silver. I'm not worried about it. We will see silver. I think when silver breaks 29.30, you can start to see it outperform gold more so at that point. But as you know, and as your viewers know, that's how these markets work. You see gold break out first, and I mean, I've looked at this, and I did a video. I wrote about this in the last couple months. Gold makes a major breakout, and then silver usually makes a major breakout. Usually it's like a couple months after, or in some cases it can be 8 or 9 months, depending on what you look at. So at this point, I don't know if 26 is the major breakout for silver or if we're going to call it 29. But it's playing out to script so far. Where you got the gold breakout, we can say silver broke out because it broke above 26. But in any event, once we see silver break 29 and 30, I think that's when we'll see it really start to outperform gold.
Yeah, because I was going to ask you, I seem to see a sticky point at $28 where it'll get past 28, it'll move a little into 29 and come back down to 28-ish, and go back down to 27-ish. So I'm kind of wondering, what is it about this 28 number, or why is it having a bit more of a rough time trying to get past it and hang on to 29 and the other 30 plus numbers that you mentioned?
It's just technicals, and it's based on supply and demand. I mean, if you go back to 2020, when the market had some peaks in the summer of 2020, and then also it made another peak. I think it was the very beginning of January 21, and there was a lot of when you look at the candlesticks and you look at even the weekly candles, there's a lot of wicks where the market opened and it went to 29 or 30, and then it couldn't hold those gains and it closed below it. So from August of 2020, that peak, to January of 2021, when I think it hit 30, the silver market quite a few times was testing those levels, but it was failing to hold them. So there's a lot of past selling. There's a lot of selling at those levels. So that could take the market a little bit of time to bust through that resistance at 29.30. But we've actually, in weekly closing terms, we've already done it. However, if you look at the daily chart, I think there's like a daily close of 29.50, 29.40. There's a couple daily closes there. And so on the daily chart, we'd probably need to see silver, surpass. We'd probably need to see it get to 30. Like if silver makes a daily close at 30, that would tell us, that it's breaking away and ready to move up to 34.
A lot of us here, we were kind of wondering here with all this talk about the high demand for silver, being it solar or green renewable energy technology. It's incredibly important, and in high demand, it's even been in a deficit for the last 3 or 4 years or so. And a lot of us were wondering why we weren't seeing really that significant move with silver, considering the demand.
Yeah, I don't know if I can put this delicately, because I know this is a silver audience, but at least in my opinion, I see no evidence that that stuff has any impact on the silver price. Silver is basically an option on gold. And actually, the gold stocks, I mean, that's for another interview, but the gold stocks, um, if you look, the introduction of gold ETFs in 2006, that changed the miners or I should say, that rendered the miners, the gold stocks, as an option on gold. So if you look at the way that gold stocks and silver trade, they basically trade like options on gold. So if you look at all the best moves in silver, they basically occurred when gold had a big breakout. So and it's the same for gold. I mean, when people talk, there's strong jewelry demand or there's a deficit, it's investment demand, which is the driver. Investment demand drives these markets on the margin. And the investment demand rises and falls based on monetary factors. And so, silver, I mean, silver is so interesting because the industrial component is significant. But when you look at the way it trades, the way it has traded, in the last 50, 60 years, it basically trades with gold. It trades like an option on gold. Again, if gold is breaking out and moving up, you're going to see silver really perform and outperform gold. However, if gold is just moving sideways or gold selling off, silver will perform worse than gold. So maybe that will change at some point in the future, and that the industrial side for silver will be more of a driver. But to this point, it hasn't been. So I have to stay with that view that it has no impact on the price. And maybe this year that silver's doing well, maybe in the statistics, we'll see that there's a smaller or, maybe maybe we'll see this year that there's even a smaller deficit, based on the supply demand. Because as you noted, the 3 years before, based on that, you would think, oh, the price should have gone up. But that's just how the market works. It follows gold. It's a leverage play on gold.
Do you think it's time where I mean a lot of people had made money in the markets, equities, all these things. But do you think it's time to start considering some form of wealth protection, considering how the economy is going and what the monetary policies may look to be?
Yeah, I think physical metal, I mean, I consider it an insurance position. I don't consider it like you're trading an ETF in your portfolio. So if if you want gold for insurance, you need to buy some form of physical. You can't just buy the ETFs. So I think you have to separate it. But yes, um I think the way things are going, we all need wealth protection. We definitely need physical. And we're in a new cyclical bull market, but also a new secular bull market for gold and precious metals. And so, as we talked about before, like when we see the stock market start to crack, I mean, it's going to be scary. Just the impacts, for economies in the West, social turmoil, conflict, more wars, all that terrible stuff that's coming. And economically, just the technical setup in gold and silver, it could lead to some really, really explosive moves. So you definitely want to think about that right now. I mean, I think in the like you may only have 3, 4, 5 months um, before you could see metals prices like really move significantly higher. Like at the end of the year, I mean, maybe you could see, you know, silver at 3,000, not silver at 3,000. I hope not silver at 3,000, but gold, you could see gold at 3,000, and silver maybe somewhere in the 40s potentially. So, um, you know, I can't stress that enough. Like, given the way the technicals are set up, that's the risk. Like, the risk is that we could see some really big moves to the upside over the next couple of years. So this is not the time to be like, oh, well, I'll just think about it. I'll get back to it in 6 months. Like, this is the way things are set up right now. Like, you got to figure out your plan and figure out how you want to protect yourself.
Jordan Roy-Byrne, before we head out, can you let us know how we can follow you or see more of your work and services you provide?
Sure. You can go to thedailygold.com. I have all my free work is there. I write a premium newsletter covering junior mining stocks, junior gold and silver stocks that I'm personally investing in. So there's that. And again, at thedailygold.com, I publish quite a bit of free work, videos, articles, editorials. Also check out my YouTube channel, which is youtube.com/thedailygold.
All right, Jordan, I want to thank you for your time. I think you've given us great insight as far as what's going on with the markets, what you're seeing in the charts, and it's really what you specialize in. So I appreciate you sharing this with us, and I hope we can do this again real soon.
Patrick, thanks so much for having me, and I'll come back anytime.
That was Jordan Roy-Byrne sharing his views on precious metals and the economy. To see more of Jordan's views and work, please go to www.thedailygold.com. If you like this video, please do subscribe, give it a thumbs up, and share. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.